Bitcoin just dropped 17%. Crypto Twitter is panicking. Liquidations are everywhere. But if you have been following this series from part 1 through part 4, you are not worried. Because you did not just guess the strategy, you backtested it, you validated it with walk-forward analysis, you stress-tested it with Monte Carlo simulations. You know your edge survives volatility. This crash is not a crisis, it is just data. Now, you might be wondering, wait, we are converting our strategy from Python to MQL5. Won't that cause alpha decay? Won't the edge disappear in translation? The answer is no. Because in Python, we already made sure we were free from unrealistic assumptions. We eliminated look-ahead bias. We proved it was profitable after deducting commissions and slippage. The code is just the execution layer. The edge was built in the validation, so let us deploy it. Before we dive into the results, let me quickly show you how to get the bot. The link is in the description. You download the zip file, extract the ex5 file, and drop it into your MT5 experts folder. Now, the EA is logged. You will see an activation key field in the inputs. To get your free key, just subscribe to the channel and email me at quantfortrading12@gmail.com. I will send it to you within 24 hours. This just ensures you are part of the community so I can send you updates. Alright. Let us talk about what happened when I actually ran this. I compiled the EA, and within 5 minutes, it took a live sell position at $60,941. Here is the crazy part. At the moment of recording, the position is down $48, but 10 minutes prior, it was up $70 in profit. It swung from plus 70 to minus 48. And honestly, that is a good thing for 3 reasons. Reason number 1, psychology. If you compile an EA and it immediately goes on a 10-trade winning streak, you think it is magic. Then, when it finally loses, you doubt everything. But starting with a loss builds discipline. You learn early that this is a system, not a slot machine. Reason number 2, proof it is not curve-fitted. Most people see a winning short in this crash and claim that obviously anyone selling right now wins. But our bot took a loss. That means it is not just blindly selling because the market is down, it is following the math. And sometimes the math is wrong. That is okay. Reason number 3, validation means individual trades do not matter. In my backtest, I know the average winner is $206. The average loser is $113. This $48 loss? It is just one data point. I already know from hundreds of trades that the edge is real. One loss does not change the math. Now, let us look at the actual MT5 backtest report. And this is where we prove there is no alpha decay. In Python, we backtested 3 years of data. That was 949 trades. The win rate was 39.9%. The profit factor was 1.20. In MT5, we only have 1 year of data, which is 157 trades. The win rate is 38.22%. The profit factor is 1.13. Look at those numbers. The win rate difference is less than 2%. The profit factor difference is only 0.07. This is absolute proof that the MQL5 code is executing the exact same logic as Python. No bugs, no drift. The edge is platform independent. Let us break down the green flags in this report. First, the math is perfect. Your average winner is $206. Your average loser is $113. That is almost exactly a 1-to-2 risk-reward ratio. You do not need a high win rate when your winners are twice as big as your losers. Second, the Sharpe ratio is 1.04. In systematic trading, a Sharpe ratio above 1.0 is considered good. It means the returns you are getting are actually worth the volatility you are enduring. Third, look at the equity curve versus the balance line. They are hugging each other tightly. This means the bot is not holding onto massive floating losses. When it hits a stop loss, it cuts it cleanly. But we also have to look at the yellow flags, the uncomfortable truth. Yellow flag number 1, the 38% win rate. Mathematically, it is fine. Psychologically, it is brutal. You will lose nearly 62% of your trades. If you cannot handle losing 6 out of 10 trades, this strategy is not for you. Yellow flag number 2, the 3-month drawdown. Look at the equity curve. From February to May, that is 3 to 4 months of no new highs. Bitcoin entered a consolidation phase, and trend-following EMA strategies get chopped up in ranges. This is exactly why we talked about regime filters in part 4. Adding a trend filter would smooth this out. Yellow flag number 3. The max drawdown is 14.26%. On a $10,000 account, that is a $1,736 drawdown. For a personal account, that is totally fine. But if a viewer wants to use this for a prop firm like FTMO, which has a 10% max drawdown rule, you will fail. The fix is simple. Drop your risk from 1% to 0.5% per trade. You will make less money, but you will pass the challenge. So that is part 5. You now have the EA. You know how to install it. You have seen the live execution and the backtest results. In part 6, I will review the first 30 days of live forward testing. We will see if the real-world results match the backtest, and we will start discussing regime filters to reduce that drawdown. Make sure you are subscribed so you do not miss it. And if you downloaded the EA, email me for your activation key, trade systematic, verify everything. I will see you in part 6.